All right. Good morning, everybody. I've seen that silly meme again where somebody says, "Hey, look, Halloween's on Friday the 13th this year." Come on, guys. Really? I'm not even going to waste time explaining why that is another really great example of don't believe everything you read on Facebook, for goodness sake. Speaking of the 13th, it's my wife's birthday today, the big 50. So, uh, those who know, give her a shout. So the CTA's liquidated a little bit. Not my birthday, but I'll pass it along. If we look back at the level of selling that you saw here, and just do a little rounding for some easy numbers, 0.05 down to 0.03. Well, we saw bigger than that before, right? When it was like 0.35 or maybe 0.37, and it dropped all the way down here, really close to zero. That was a significant move, right? And put a date on that. That was the tariff Monday or whatever that day was, right before he capitulated, right? When they finally bent him over a barrel. Or back here at the start of April. So sure, this, it looks and it feels kind of violent, but I think this might be a more appropriate example of what we had. And if you look, there's a little bit of a bounce in there, right? Even the change in the market structure, the S&P is this white line up here. And if you look at that sell-off, it wasn't that violent, but we had a more systemic, that's a good Monday word for you, sell-off here. Lasted longer. It went deeper. It was sustained through multiple trading days, and it paused along the way for a pullback, some consolidation. So one day doesn't mean anything. We need to see it come through. The stats were off the chart. I don't know if you guys, poke around different publications on the weekend. I've long figured out that I don't know it all and I can't see it all. So I like to read the point of view and perspective of other analysts. And they saw more options trading volume yesterday, well, Friday, than has ever happened in a single day in the entire history of the stock market. How's that for a record? There's a first for everything. Well, we did it Friday. So I say we. If you had any participation in the options market on Friday, then we you had some of it too. Highest options volume session in the history of the stock market, 110 million contracts. Just to put that into perspective, the S&P, like the SPY, usually trades, oh wow, like 100 something. Let's look at the average. Not a lot, right? All things considered, it's not a lot. If you add up all the S&P products between the SPY and the SPX and the XSP and the S&P 100 one, which I always forget the name of because I never look at. Collectively, the options combined for quote S&P products is more than, I think the stat is 65 to 70% of all the market's options traded in a single day. So there's 14,167,000 on just the SPY by itself. 14 million. If we didn't even look at anything else, that number that was 110 million, that means 100 million contracts were traded somewhere else, somewhere. $7 million in SPY. These were considered panic levels, right? The off the cuff remark about tariffs, SPX another 6.5 million, caused a flight to safety panic that rippled through the marketplace exceedingly fast. And even the ES had 1 million contracts traded on the option side. So it's likely not done, but getting a bit of a rebound makes sense because of mean reversion and least squared methods. It's a little early in the day for that too. Another stat was ETF as percent of tape. I wish I had some of these fancy tools that they use where they could see how much of the total aggregate tape was just ETF volume. You know, there's so many products now that will allow you to run loss harvesting, tax harvesting, ETF index. Really neat products. And they've been pumping it, promoting it last 3 months. You know, trade the index. Harvest loss. Yeah, I bet they felt that Friday. Now the poly market says the chances of tariffs are down to like 11%. It was at 100 Friday. Gotta love that poly market, right? All right, Japan down 3%. I don't really know any other way to say it. Watch Japan, right? I mean, you can watch the JGB 10-year. You could just watch US dollar Japan. You could look at, you know, some of the carry trade proxies that we all know and love, but watch Japan, right? It's kind of a big deal. You're gonna feel it. Behind that, we got Hong Kong, Europe, then the Dow, S&P, small caps, and at the top is the NASDAQ. It's interesting how much of a rebound we got in small caps. I got to say, out of all the things that I saw, that was a little bit of a surprise. For those who haven't caught on yet, the market is open today, but bonds are not open today. It's this weird thing. There's this white paper. I'll try to find it for you guys that talks about how they need X amount of days closed every year in the market. And so long ago, they sat down and hashed out how they were going to get those X amount of days done. And of course, Juneteenth was a new holiday that they weren't prepared for. And that one kind of threw a wrench into the whole scheme. But yeah, they need an X amount of days closed every year. And this is that one weird one. So if you're new to trading, just, you know, write it down in the books. This is that weird one where you got equities open and bonds closed. Somebody was asking about the Trader's Almanac over the weekend. And yeah, there is one. There's not one for bonds, which I was surprised. I honestly thought there was. There are some good resources for bonds, which is probably why they don't have a bond almanac. But there is a yearly publication that you can get. The 2025 almanac isn't worth the price at this point, you know, with it being October, but you should look into the 2026 season. It's not going to help you as a day trader necessarily, or at least it isn't worth the money for if you're just day trading. But if you're swing trading and holding longer term, it has depth and context and background and really gives you a larger perspective on seasonality, global trends, and really great insight and tools. So, I don't get anything for bringing it up, right? It's not like I'm an infomercial for an almanac, but man, if you've never looked at it, go take a look at it. And the way that AI keeps digging into paid sites without paying the site prices, who knows? You probably have access to the 2025 almanac without even buying it. We don't have anything on the docket today unless it's just a surprise that pops up. And we're still holding above that 89.5 swag line, that swag lever we drew last week. That squeeze in silver, it doesn't look like it's done yet either. So we are opening below the zero line today. The defining characteristic of being above and below the zero line is how the dealers typically would behave into market breakouts and breakdowns. Now, one, we're inside day, and the day that we're inside of is massive. 6,800 on the top side, 6,550 on the downside. Didn't I say we were running 50s? So that's a really big range. The idea that we're going to break the range today, while it's absolutely possible because price can do whatever the hell it wants, it's not a high probability, high conviction concept that we're going to break the range. So the zero gamma concept would be if we was to break out, say go higher, and we're in zero gamma, they would buy into buying and it would rip higher with velocity, or they would sell into selling and we would fall a lot faster and a lot farther because we're in a zero gamma environment. If we were in a positive gamma environment and we attempted to break out, they would sell into that breakout and we would come back in. Or if we fell down, they would buy into that weakness and we would come back up again. That's why in a typical, regular, good, bullish backdrop, we have nice, clean, uniform days where price really doesn't exceed too much, doesn't get out of control, and we just have these really nice, beautiful days, right? That's a positive gamma environment. And sure, we can break out and we can run, but they're not 2% days and things don't get out of control. That's positive market conditions, positive gamma market conditions. But when we're in a zero or below zero gamma market environment, the days are much bigger, the moves are much more violent, and that's because they're selling into selling and or they're buying into buying, and it can get really violent. Some of the bullish moves we've ever seen in the history of the market has happened in negative gamma environments. So that this one day that I've got my mouse on, April 9, the capitulation day, it was so wildly bullish because we were in a zero gamma or under the zero line. We were in a negative gamma environment. And the dealers were buying into buying and it just ripped to the upside. All of that is predicated on the idea that we actually get a breakout of something. If we're just sitting inside the range, we're not breaking out of anything. There's also the idea that we're not that deep into zero gamma. We're 40 points below the zero gamma line. It's within the range of a average daily move, which before Friday's move, our average daily move was 50 points. Zero gamma is only 40 points away. So that doesn't qualify us in a extremely heavy, deep, negative zero gamma environment. We're not on the line, but we're pretty close to the line, and we can jump over it. And that's not gonna fit that model that we were just talking about. Which, by the way, Volland has argued that that model is antiquated and generic. I mean, that's some pretty bold statements, and they've backed it up with a lot of science and research. Their argument is that sometimes we're in those kind of environments. They just call it the, well, I don't want to misspeak. They have a name for it. We'll just say it's normal gex. That's not what they call it, but I need to call it something. When we're in that kind of environment, sure, what I described is exactly how it works, but that's not the landscape that we're in every day. And in fact, even through the middle of a single day, you can change from one regime to another. The word that they use is paradigm. You can change from one paradigm to another. So it's interesting, if you haven't checked out Volland, they say that spot gamma is poo-poo, and that it works sometimes when we're in the right vol environment for this dealer logic that we were just discussing. When we are in that environment, it works really well. Cheers. But when we're not, it doesn't. And if you don't check to see if we're even in that paradigm, then how do you know that you should be using it right now or not? Pretty bold statement, but is what it is. That's Volland, by the way. And their science backs up their statement. But I guess the argument could be made, that sometimes VWAP works really good too, right? And sometimes Bollinger Bands work really good too. And sometimes, right, you get the idea. Sometimes everything works, sometimes. But they did make a really good argument about knowing what paradigm you're in and asking, has it changed today, since it can change intraday? That's a really good key question to be able to ask and to have the tools to be able to check. Overnight volume, 183,000. That's more than double of our average. The average running anywhere between 40 and 70, really. So it's more than that, right? Double. And the way that this tool works is it starts adding things up at midnight. So that's basically Europe's volume. Yeah, overnight trading, it has some Asia in it. Even after Asia closes, it has some US traders in it, even though we're closed. So it's not, quote, all Europe, but we just stick it into that basket. That's some heavy trading, all things considered. 183,000 in the overnight. I can't remember the last time we had that much in the overnight. Been in the hundreds, sure. But more than 120 or 140? Been a while. I don't think we had any in 2025, now that I think about it. Maybe around that April 9 timeframe, maybe. The put wall and call wall did move. The put wall went down and the call wall went up into levels that we have never seen the call wall before. So there is that too. It's all the way up at 7,050, basically. Nice round number. It seems a bit extreme, doesn't it? Still, it does highlight the market's insight or perspective of where they expect that price could go, because these levels are not some analyst using a measured move saying, oh, I think we could hit that. This is money being put into the market at those levels. That's a completely different thing between chipping your teeth, running your mouth, and actually just putting your money where your mouth is. I do too. I think a lot of those studies now are broken and they need time to be fixed, right? And that's something that's always hard for newer traders to grasp is that if we get these sort of moves, it breaks things and the markets need to heal. First time I heard that language about a market healing was at stockcharts.com with David Keller. Uh, Interesting concept, but once you sort of wrap your head around it, it's not that bad. That's a smart dude. All right, so looking at the ADR for the day, we've made the entire daily range. And the daily range on Friday was 50 points, 50. It's now at 64. It increased 14 points between Friday and today. And we were still easily able to hit it and exceed it. And we're still hanging out up here above the ADR half line. Now we've left this gap behind and it's bigger than you think, right? Because we got to go all the way down here to get that gap closed. 65.52 and a half. And we open up at 66.25 basically for some easy math, right? So it's a 75 point gap that needs resolved. And it will get resolved someday, eventually. Maybe not today. I did mention Friday that we could make a 2% move. And we did more than that. So I kind of feel like I missed the boat there a little bit. So at this point, we need, if we're looking for some downside plays, we need to break this lower ADR, get back to our own Globex low, break that, and aim for, you could go for the 4 o'clock close. After that, go for the absolute low of Friday, which should tangle you through those two ADRs and then expand to the downside. So we have levels to play down there. $66.32 cog line. Imagine that. There's the 4 o'clock close, 66.05. And then the real low of Friday, 65.40. And along the way, you could probably just knock that 4 o'clock one off of there. It's just run the ADR, which is also 6,500, the nice round number. And then the cog line up here at 11. And then another one at 92. So you got multiple levels to play on the way down here. That's if we go down at all, right? Now on the other side of this, if we can run back up, we got a little bit of a liquidity gap here. Get through that. You got the Globex high. And then beyond that, you want to start focusing on things like the RTH mid. Looking at the structure of this, you could consider just using, between 9:30 and 4. Oh, well, that lines up on the ADR full, so we don't need that one. 67.50, we don't need that one. So yeah, don't even need to worry about the mid. Just catch 67.50. You got your levels to the upside. All right, the daily pivot and the weekly pivot are on top of each other today, and our daily pivot channel is as big as the entire week's channel. That's how big the move was on Friday. So with that in mind, we talk about big channels and how it implies that if we break out, it doesn't stick. That's a really big channel. And it's saying if we break out of yesterday's range, it likely doesn't stick and we come back in again. That's not a surprise considering how big yesterday's range was. Just getting to the edge of yesterday would be a massive coup, let alone getting past that and keeping the breakout and continuing to go farther than that. So a little bit of Captain Obvious on that one, like thanks, but I think we saw that coming. On the other hand, though, the size of both of these implies either that the weekly pivot didn't really feel the brunt of that move and didn't expand bigger, or that it did expand, but it still didn't exceed the daily one. To me, it just seems like the weekly didn't get impacted by that move. And that makes sense because if we looked at the move from Friday and if we just compared that to the entire week's move, then it doesn't sound so bad, right? If we say the S&P moved 250 points in a whole week, well, that doesn't sound like much. And that's the way that the weekly indicator's reading it, is that last week we moved whatever that was, 250 points. And for a week, that's not bad at all. So the indicator for the weekly pivot didn't really change that much. It's really going to mess with the SNR lines because they are derived based on the previous day's trading. So S1 and R1 are a long ways off. R1 is 67.25 and S1 64.58. That's a long ways off. It does imply the downside over upside, right? The way that we can read that implication is that this red line is closer to the floor pivot than this green line is. In fact, the green one is nearly double the distance than the red one. At least it seemed like it. Without getting the calculator out and kind of nerding up on it, you could just use your drawing tool. It makes things a heck of a lot easier, at least just to give some perspective. So if you draw this distance, I know you Canadian engineers probably going to just get the abacus and whatever, nerd out on it. Almost 100% more, right? A little bit of an overlap there, which is why I say almost, because that would be 100%. Close enough for me. This S&R line is indicating that going down is a lot easier in this scenario than going up, and that it's more likely that we go down than up. Just keep in mind that this indicator doesn't make price do anything. It won't make us go down. It won't help us go down. It won't stop us from going down. It's just giving insight into what's more likely, that we go up from here or that we go down from here. And it says it's more likely that we go down. All right, that's a really weak end to a profile. And if it wasn't for this little bubble here in the middle, that would be a fantastic P-shaped profile. We are building out that 62 area. I wouldn't be surprised if it forms more around the 6650, but right now either they're front running it or they're trying to save it. We're seeing some work put in, and we saw that on Friday too when we got down into that 6650. You can see the work that they tried to put in there, and then now today in this really nice distribution that we've started for the week. We're back down into this triple layer all these points of control. And no, they don't stack on top of each other perfectly because, in the real trading world, that's not how things work. But they're close enough together that this entire zone should be something to pay particular attention to. And it's just under that 65.50 level. That's a line in the sand we really don't want to break, right? The fact that we got down there, we tagged it, it held, we bounced, all well and good. We want to see that hold from now on, right? I don't even want to see us go back and test it, let alone get underneath it. We don't leave that thing completely alone. If that breaks, I think we're looking at a broader, deeper sell-off, say back to the 200 daily. So that was a 50 period bounce, or a 50, because we've been running 50s. There's a 50 MA, and then there's just price action at 50. It was both. So we need to keep that now. I'm not even going to change this one. We're just going to stay there. 10-day, 30-minute volume profile with TPO. I had mentioned last week that we had an opportunity to have this really shrink up, and that we'd have a nice, tight value area, and it'd be like 100 points. It'd be all nice and clean again. Yeah, no, that's gone. Now that we've did this really wide expansion, this is now our new reality, and we've got to shop around for a new home for this point of control. First thing we're looking for is the value area to expand. So this lower bar, we're looking to see it move, and then we'll expect to see the point of control move. There's no contender at this point, right? There's no place for this to go, no new home. We're going to need to hang out in an area and heal, digest this move, and see that point of control move at that point. So for right now, we got nothing other to show in another perspective how weak this low was, that reversal. That was not a reversal because buyers stepped in and picked it up, right? That was a reversal because sellers got tired and just stopped selling, or they ran out of time. I guess you could argue here in this zone, that's more of what it looks like when buyers step in, right? That's kind of the idea behind it, as opposed to that, which is where we just ran out of time on the selling. Still, we have a VPOC overhead now, and that key level that we've been keeping track of, yeah, no, that's done. $67.92 cog line. I don't get this thing to the tick. If that's what you want to do, you can fight it and dial it in. Points are close enough. So not a surprise if we make a move to the upside. 67.92 cog is something that we're going to have to deal with. For today's price action, there's really not a lot of insight yet on the TPO and the volume profile in-house so far. A lot more volume across that high on less trades. So, that kind of stands out a little bit. Other than that, there's nothing here this morning. All right, now for the range. So every Friday we get this opportunity to measure the range that we had on the current week that we're in versus what's projected for next week. And when we did this on Friday, the projection was, it wasn't that much bigger, if you remember. Right? It was really close to the week that we had. But by the end of the day on Friday, this is how much more the range has expanded. And we've already hit the edge of the weekly expected move. 66.92 cog line, nice easy round number, and 64.11 cog line on the downside. I couldn't have made that up if I wanted to. You know, everybody keeps asking what's so special about those cog lines, but they just keep coming back again and again and again and again. So big round options levels 65.50, 66.92 cog, 64.11 cog. Looking at how we're doing on mean reversion or the lack of, we're still more than 1.25% above the 10-week. It's a little closer to the 10 than I'd like to be, but we are still above it. I think this is going to take a little bit of time to heal. You can see how we went from +3 to nothing. It's flat down there and then back up again. So that's a lot of violence, but it's still healing. And what this shows is when we're trying to ask that question, have we moved too far too fast? And does it owe us any sort of pullback or mean reversion? Not on the weekly, so not on the swing. Looking at the 10-day, we were more than looks like closer to 2.5% underneath the 10-day moving average. And that is a representation of too much. That's too far, too fast, and we do look for a pullback. We already got it though. Now we're back really close to the collar that I like to focus on, the 0.5% above and below, or the 1% above and below. We're within those two boundaries. So we're no longer overbought or oversold or having moved too far too fast. That sort of mean reversion least squared method stuff, it happens fast. So if you're looking for Z-score mean reversion, you got to catch that stuff intraday, right? You already missed it. It happened Friday. This says that boat already sailed, so too late. We're not overbought. We're not oversold. We're not overextended. Looking at things that are down this morning, the Mag 7 down volume is down. It's down 5%, but over a 5-day period, it's still up almost 6. Combined, that means it was up almost 11%. The Mag 7 down volume was up 11% in a 5-day trading period. It gave back 5 of that. It's still up almost 6% of that. The VIX, down almost 5% today, is still up over 19%. So it was up more than 25%. Bitcoin still down, and more Bitcoin, some more Bitcoin. It says the OEX is down a half, but that one doesn't do good in pre-market. So we kind of ignore that one for now. And then the rest of these aren't down enough. The benchmark is a 0.5%. So flip it over. Let's look at the other side, looking at what's up this morning. We got China, uranium, Mag 7 up volume is up. Metals and mining, China again. Chips, uranium, quantum, precious metals, China again. Tech, bots, Mag 7 again. UFO, so a little bit of speculative. Mag 7, again, growth. Banks, growth. IPO, that's your small caps playground. IGV, expanded tech. So there's a world that we focus on when it comes to things that are up in the morning, that some things are more important than others. I know nobody wants to hear that they're not important, but if you're looking for a rally day, you want these three or some proxies of these, right? XLF, that's just generically, it's finance. But that to me is too generic because it's got trading desks and insurance companies and all kinds of just quote finance. So I like to see banks specifically, like regional banks, but banks in general. But we need some form of XLF in the pre-market if we're going to look for an upside rally day. We need some kind of finance. The middle one, just generically speaking, tech. Well, it can be fintech, hospital tech, cloud computing, chips, any kind of tech, really, right? But tech that ties in better with consumer discretionary is helpful. So XLK, really generic. If you was to swap that out for cloud computing or chips and software more specifically, we need that. And then, of course, consumer discretionary. So if you can get two of these three, you got the opportunity for a rally day just based on growth versus value logics. But every day we have to ask the question, what's going to be the driver? It could be growth versus value, Mag 7 and the boys pushing everything out of the way and ripping to the upside. And those 7 to 10 names can carry the 490 others as long as they're just sitting on their bum and not doing anything. They can do it. But if 490 are going down, those 10 can't lift us higher, right? They can't fight that. But if they're going up, we got a chance that we can go up. And we can see that in the pre-market. But then there's also bonds, treasuries, commodities. We got to keep our eye on those and see what's going on. Well, Japan's a big threat. So you definitely want to keep your eye on that. Having these names up in the pre-market is a really good start, having these sectors up in the pre-market. But it needs to be followed through once we get into the open, that we actually want to see, you know, Apple and Microsoft and Nvidia and whatever. We want to see the Mag 7 pushing with some help from banks, finance. We need it, right? But they can't do it alone. So no 0 day that's really negative and heavy and moving to the downside. No inverse market reaction from gold, oil, dollar, yields, right? So you want to keep cycling through those charts. It's not like you got to sit there and have 5 screens up watching everything that's moving. Just cycle through the charts every 10, 15 minutes. It only takes 30 seconds. You look through the charts, you go back to your regular product that you're trading. You know, it's like I've always argued. If you're trading Facebook, don't just sit there and stare at Facebook. Look at everything else that's going on, because Facebook's not moving because of Facebook. If you're trading the ES, the NASDAQ, whatever, the analogy holds. Don't just stare at the one thing you're trying to trade. So gold's back up. We are getting that breakout, trying to get above 4,100. $10-year a little light. Crude is trying to get back above that 60. Can't believe we actually almost made it to 58. It doesn't look done. You know, this seems like a really nice stair step. Lower highs, lower lows. The pullback here stalled. Didn't even make it through the mid. Eventually, crude is going to start going up, and that's going to mess with things. Cost of doing business, travel, transporting goods. But right now, that's like a tomorrow problem. And then the dollar, not above 100, but still holding above 99. And we need this to back off. We need the dollar to go down, but we don't want to see big violent moves in the 10-year or the dollar. We need the 10-year to go back up, just kind of creeping back to where it was, nice and easy, and the dollar to get back below 99 and then back into like 98.5 or even 98, but nice and easy, no fast moves. If we start to see this pick up speed and move fast, buckle up, the market could get pretty violent. That's not even an up or down issue, right? That would just be a violent issue. We'd have to see which way these two are moving to figure out which way this one is going to go. Because it's not like the VIX, right? When the VIX goes down, we know the S&P is supposed to go up or vice versa. Dollar and treasuries, they're not so easily organized into, oh, they're going down, so the S&P should go up. Yeah, no, that's not exactly how it's going to work. Pot stocks and uranium are leading the pack today. You don't want a rally day based on pot stocks. Behind uranium, we got China, and then chips and precious metals, and then pot stocks and precious metals, and then China again, and airlines. All of that is above tech and Mag 7. So let's clean that up, right? Keep your eye on those. And otherwise, if you're just looking for something to day trade, I would keep my eye on pot stocks and emerging markets and some maybe metals and mining. Those mining companies are cheap, make for some fun day trades, make some money on those. And that's if you're just looking to get out of the way and leave the indexes alone, right? Because of course the indexes, everything is now trapped inside of a really big bar everywhere. And that just makes for some tough work. So it's what I got for you guys. We got the capacity to make the rally back today. That's the long and the short. But why would we? Right. And I keep coming back to that. Well, why would we? We don't have any economic data unless the president clarifies more on this tariff regime, which, smacked us down to begin with. I don't expect that we do anything today except hold the line and digest the move and try to heal. There's a lot of healing that needs to take place. And that if we do begin to get wild, just watch the rate of change indicators. So I got for you guys, be careful, be safe. I'll see y'all tomorrow.